One of the greatest businesses ever built is now trading at one of its cheapest valuations in years. And Wall Street is terrified of it. Microsoft, down more than 24% from its highs. Bloomberg called it the company's worst quarter since 2008. Price targets slashed. Analysts turning cautious. Investors asking whether the stock that used to feel like the safest trade in the market is now a trap. But here's what nobody is talking about. The fear might already be priced in. And if that's true, if the market has already punished Microsoft for everything it's scared of, then what you're looking at right now could be one of the most interesting entry points we've seen in nearly a decade. Today, I'm going to break this down properly. We're going to go through why Microsoft got hit this hard, what the valuation actually looks like right now, what needs to happen in earnings to flip the narrative, what the charts are telling us, and at the end, I'll give you my honest, direct verdict. Buy, hold, or walk away. But if you're serious about understanding how to analyze situations like this, not just what to think, but how to think, hit that subscribe button right now. This is exactly the kind of deep dive we do here every day. Now, let's start with the fear, because if you don't understand why Microsoft fell, you can't understand whether this is an opportunity or a value trap dressed up to look cheap. The first thing to understand is this was not one sell-off with one cause. Microsoft didn't fall because of a single bad quarter. It fell because the market stacked 4 or 5 different fears on top of each other all at once. And when fear compounds like that, even elite businesses get repriced fast. So, let's go through them one by one. Fear number 1, Azure wasn't growing fast enough. In the most recent earnings, Azure came in at 38% growth. Solid, objectively good. But the market was pricing in 40%. 2 percentage points below expectations, and the explanation management gave that GPU capacity was being consumed by internal applications rather than external customer workloads did not land well. It raised a question investors absolutely hate. Who is actually benefiting from the AI spend right now? Customers? Or just Microsoft itself? Fear number 2. Copilot isn't monetizing quickly enough. This was supposed to be the clean AI monetization story. Plug AI into Office. Plug it into GitHub. Plug it into the enterprise stack. Revenue flows automatically. Except markets don't stay simple for long. The questions are sharper now. How much are users really paying? Is the product actually sticky? Is adoption real, or is this still a trial phase? These questions don't have satisfying answers yet, and that's a problem for a premium stock. Fear number 3, the CapEx burden. This one is the biggest philosophical shift in the Microsoft story. For years, the pitch was simple. Microsoft is an asset-light, high-margin software compounder. Cash generative, scalable, beautiful business model. AI has complicated that. Now, Microsoft is spending tens of billions building data centers, securing GPU supply, and locking in infrastructure commitments. And once that spending exploded, investors started asking a much harder question. Is Microsoft becoming more capital-intensive than its valuation ever priced in? That is a fundamental re-rating question, and it hasn't been answered cleanly. Fear number 4, OpenAI dependence. Here's a number that rattled markets. OpenAI represents 45% of Microsoft's cloud backlog. 45%. That is enormous concentration in a single counterparty. And OpenAI itself has its own financial pressures, its own burn rate, its own need to prove its economics. So investors started asking, what if OpenAI can't follow through? What does Microsoft's backlog look like if that relationship weakens? None of these fears are irrational. They're real. They deserve to be taken seriously. But, and this is the crucial question, has the market already priced all of this in? Or is there more pain coming? Drop a comment below. Do you think Microsoft has already absorbed the bad news? Or do you think earnings could hit the stock again? I read every comment. Let me know. Let's spend a minute on CapEx specifically because I think this is the most misunderstood part of the Microsoft story right now. The narrative around Microsoft's infrastructure spending has swung dramatically. A year and a half ago, Microsoft actually paused a number of data center projects. At the time, leadership questioned whether the demand projections they were being given were real. The market reacted badly. Investors saw it as cold feet. Fast forward to today. The exact opposite problem. Microsoft can't find enough data center capacity. Their business is being constrained by supply, not demand. They undershot their own demand projections. and now they're in a race to catch up. So, think about what that means. Microsoft's mistake wasn't overspending, it was underinvesting. And now the market is penalizing them for closing that gap aggressively. Is that fair? Partially. Capital intensity is a real concern. Free cash flow under pressure relative to operating profit is real. But there is a difference between margin pressure from growth investment and a broken business. Those are not the same thing. Microsoft's operating profit is still rising. Net income is still enormous. Free cash flow, even under pressure, is massive in absolute terms. This is not a company struggling to generate earnings. This is a company choosing to invest those earnings into infrastructure that it believes will compound over time. The question for investors is whether you believe that bet pays off. And based on the data, based on Azure growth, based on backlog, and based on enterprise demand, I think there are real reasons to believe it does. Now, let's talk about the other elephant in the room. OpenAI, one of the smartest criticisms of Microsoft right now is this. Unlike Google, Microsoft doesn't own the full AI stack. Google has its own chips, its own model, its own applications, everything vertically integrated. Microsoft is relying on OpenAI, and that's a structural dependency that investors have decided deserves a discount. Is that fair? Yes, partially. But here's what the bears are missing. The OpenAI contract runs through 2031. Nothing changes before then. And Microsoft is far more than its OpenAI relationship. This is a business with enterprise software, cloud infrastructure, productivity tools, security, LinkedIn, GitHub, gaming, and search. Multiple massive revenue streams. None of them dependent on OpenAI in the way the headlines suggest. There is also a nuance in the concentration risk argument. Yes, OpenAI is 45% of the backlog, but that tells you OpenAI is consuming enormous amounts of compute. That's a customer that is growing. That's a customer that is scaling. The risk is real, but it's not the disaster narrative some people are building. Still, the perception matters, because right now, Microsoft doesn't get the benefit of the doubt the way it used to. The market has become more demanding. It wants proof of monetization, of differentiation, of return on AI spend. And until that proof is delivered clearly and repeatedly, the stock will stay in what I'd call the prove-it zone. Here is where the story starts to get more interesting. Because all of this fear, Azure anxiety, Copilot skepticism, CapEx pressure, OpenAI overhang, has already knocked the stock down significantly. And that changes the math. For years, the obvious criticism of Microsoft was simple. Great business. Too expensive. That argument is a lot harder to make today. The forward PE is now well below its own 5-year average. The stock is approaching valuation levels it hasn't seen since before the AI era. And when you look at intrinsic value, using a discounted cash flow model with conservative assumptions, the numbers look genuinely interesting. Here's what I mean. A base case intrinsic value of approximately $481 per share against a current price around $424. That is roughly 12% upside just to fair value. Not bull case, not moonshot, base case. The low case still comes out around 440. The more optimistic scenario, using growth assumptions that are not unreasonable given Microsoft's track record, gets you into the 520s. Wall Street consensus targets sit around 572s. That implies over 35% upside from current levels. Now, could those targets be wrong? Of course. Analysts can be too bullish. Models can be too generous. But the point is this. Microsoft no longer has to be perfect to make money from here. It just has to be better than the market's current worst-case assumptions. That is a very different setup than buying Microsoft at $450 when everything was priced for perfection. Let me give you one more data point on valuation. Microsoft's return on equity is strong. Return on invested capital is strong. Earnings per share has compounded meaningfully over time. Free cash flow per share, even with AI spending pressure, has grown. This is not a story of a business deteriorating. It's a story of a business investing heavily and the market losing patience while it waits for the returns. By the way, if this analysis is adding value to how you think about investing, hit the like button. It genuinely helps more people find this content, and I appreciate it. When you look at the quality scorecard, profitability versus the sector, profitability versus its own 5-year average, Microsoft rates elite. We're talking A-plus level across multiple metrics. That quality does not disappear because the stock fell 25%. What quality does over time is compound. And at a better price, that compounding starts to work more in your favor. Now, let's look at what the chart is telling us. Because I think there's something important here. Microsoft is no longer floating miles above its long-term moving averages. On the weekly chart, the stock has come significantly closer to its 200-week moving average. And historically, that level has marked much more attractive entry zones than the euphoric peaks. That does not mean the stock cannot go lower. It absolutely can. But it means the technical setup looks very different from buying Microsoft when it was everyone's consensus safe trade. Zoom out to the last 5 years. Zoom out to 10 years. Microsoft has consistently outperformed. And more importantly, there are multiple periods in that history where the market questioned the company, compressed the valuation, and then later realized the business was still compounding quietly underneath. This feels like one of those periods. Now, history does not guarantee future performance. I want to be clear about that, but it does remind us that Microsoft has been through investor skepticism before, and the business kept growing through every single one of those periods. One more thing on the chart, the 52-week high drawdown for Microsoft right now is around 25%. Across the board, that puts Microsoft among the hardest hit names in the large cap space. Some of that is justified, but some of it is the market overshooting in the other direction. And when markets overshoot, when fear compounds and becomes larger than the actual risk, that is where opportunities are born. Now, let's talk about what actually matters heading into earnings. Because this is where I want to be honest with you. Microsoft has a strong historical track record. In the last 8 quarters, they beat EPS expectations 6 times. They beat revenue expectations 7 out of 8. That is genuinely impressive consistency. But here's what matters more than the beat rate. The stock reaction is mixed. A beat does not automatically equal a rally. Sometimes guidance matters more. Sometimes Azure growth matters more. Sometimes CapEx commentary matters more. Sometimes the market is already focused on a different narrative entirely. So, if you're thinking about buying before earnings, you need to understand exactly what you're doing. You are not buying a stock that will automatically pop if it beats. You are buying a stock that has already absorbed significant punishment at a valuation that looks genuinely more attractive, with the thesis that even if the quarter isn't perfect, the long-term risk-reward still makes sense from here. That is a different mindset, and I think it's the right one. What would change the narrative cleanly? Azure acceleration above 40%, clear Copilot monetization data, management commentary that gives investors confidence the CapEx cycle is near its peak. Any one of those things could start to shift sentiment. What would keep the stock under pressure? Another miss on Azure, vague answers on AI monetization timelines, more CapEx without a clearer payoff timeline, a cautious guide. The setup is interesting, but not effortless. One last thing on the positioning picture. Among serious long-term investors, what are sometimes called super investors, Microsoft is the #1 most held stock. It's the most bought stock across the last 2 quarters. Congressional trading data continues to show up with Microsoft again and again. Institutional ownership remains very high. Now, you don't blindly follow anyone. That's not the point. The point is that when a stock falls this hard, you want to know whether informed capital is abandoning it or quietly stepping in. And the answer here looks like stepping in. So, is Microsoft a buy, a hold, or something to walk away from? Let me give you my honest framework. If you already own Microsoft, this is a hold. The business quality is too high, and the valuation is better today than it's been in years. One imperfect quarter does not change the decade-long compounding story. You stay patient. If you want to buy Microsoft, I think this is a reasonable place to begin building a position. Not all in 2 days before earnings, but starting to accumulate at this valuation with a multi-year time horizon. Yes, I personally would. If you are purely short-term and only care about next week's move, be cautious. Microsoft history makes clear that even solid results don't automatically produce a big pop. The short-term setup has uncertainty. Respect it. Here's the deeper point I want to leave you with. Investing is not about finding stocks that are universally loved. It's about finding great businesses at better than average prices, then having the patience to let them compound. Microsoft is not universally loved right now. It's under scrutiny. It's in the prove it zone. But the business underneath the scrutiny is still one of the best ever built. Enormous profit engine, massive enterprise moat, free cash flow machine, elite returns on capital, the largest installed base in enterprise software, and AI infrastructure that is being built now to power the next decade of growth. The debate is not whether Microsoft is a great business. It clearly is. The debate is whether it deserves the same premium as before. And if the answer is no, if the market decides a slightly lower multiple is appropriate, that still does not make the stock unattractive from here. If anything, it makes it more interesting. Price is what you pay. Value is what you get. Right now, the price is far more aligned with the value than it's been in a very long time. Now I want to hear from you. 3 things. First, smash that like button right now if this breakdown added value to how you think about this. It genuinely helps more investors find this content. Second, subscribe and hit the bell. We do this level of analysis every single week. If you want to build real wealth, you want to be in this community. Third, leave a comment. Do you think Microsoft has already priced in enough bad news? Or do you think the stock could get hit again on earnings? Tell me your honest view. I respond to comments. I want to hear where you're at. And one quick note, nothing in this video is financial advice. This is my analysis based on my own research. Your situation is different. Always do your own due diligence before making any investment decision. Next video, we're going deep on a name that has barely moved during the whole market sell-off. And I think it's telling us something very important about where capital is quietly rotating. You do not want to miss it. See you then.